Hey, what's going on guys? It's your boy Nick, back with another video, and if you're new here, welcome to the channel. In today's video, I'm going to be sharing with you 5 different dividend stocks that I would deem to be recession-proof that I've been watching over the past few weeks during this stock market crash. Now, what you need to know is that all of these companies that I'm going to be sharing with you today have been known to pay and increase their dividends for 25 consecutive years, earning themselves the title Dividend Aristocrat. Investors tend to flock their money into stocks exactly like this during bad economic periods like we're experiencing right now, and that is because it can preserve their capital. They provide a little bit more security while paying a dividend during this bad economic time. But what we all want to know is what exactly makes these businesses recession-proof in the first place, and can I trust them? And it all comes down to the underlying business models of each of these individual businesses, which I'll be getting into later in this video. And so before we start getting into these 5 recession-proof Dividend Aristocrat stocks, there are 3 things that I want you guys to understand before we get into this video. And the first thing to understand is that just because a stock might be recession-proof, it doesn't mean that its stock price can't fall, and that'll probably come as obvious to most of you guys out there. But as you'll find in this video, most of these companies really don't even fall as far as the general market index, never mind some of these airline and cruise line stocks that we've seen recently. Now, the second thing to understand is that most of these companies have very large market capitalizations and have been around for a long time. Without giving too much away right now, these companies are some of the biggest in the world and have some of the strongest brand names you can think of. And thirdly, most of these companies will not be trading for a very cheap price during a normal bull market environment. Many of these companies have very long track records of growth and have been around for several decades already. Along with that, they've been paying their dividends for over 25 years, so they are trading at higher valuations. And many times it's really hard to start a position in these companies at very low valuations because they are always trading at these higher valuations, but right now is providing some fairly good value. And so with that said, if you do enjoy this video, make sure to tap that like button for the YouTube algorithm. And then if you haven't already, definitely consider subscribing down below for more weekly videos just like this one. So without any further ado, let's jump into these 5 recession-proof dividend stocks to be watching right now. Alright guys, starting off with stock number 1 here, and that is a global manufacturing company that brings science into real life. And of course, that is none other than 3M with ticker symbol MMM. 3M is a company that produces products impacting industries all across the globe, like healthcare, manufacturing, safety, automotive, energy, and so many more. And it's actually hard to find a company out there that's better diversified than 3M because they do impact so many industries across the globe, and actually 60% of their revenues are generated outside of the United States. Many of you will have heard of the products that they produce under brand names like Post-it, Scotch, Nexcare, Filtrete, and many of their own masks under 3M, and many other products that they produce themselves. Now, what we found recently in their stock price performance is that they've dropped to nearly 40% off of their all-time highs from earlier on in 2019. Now, it should be noted that the stock was dropping quite a lot before the current issues that we've been seeing in the market lately. And that is because of certain litigation claims that have been put against the company for producing perfluoroalkylated substances, which are PFAS, and they're known to cause harm to human health. But along with that, the company has been estimating lower guidance throughout 2019, meaning that their forecasted earnings estimates are going to be a bit lower than they expected. And then of course, with the current issues in the market, this is the cherry on top, and it really has sent their stock plummeting. But I am only seeing this as a great buying opportunity because this company has a forward annual dividend yield above 4% right now, and so that's really solid. Now, we do find right now that their current dividend payout ratio is at about 74%, which is slightly above my normal criteria of 60% or lower. But for a company like 3M that's consistently paid their dividends for 61 years straight and hasn't missed a dividend payment since 1916, it really doesn't bother me that much. Because a company like this is always going to be able to continue producing earnings because a lot of their products that they sell are required for manufacturing facilities and personal health, honestly. And so that's what gives them a huge competitive advantage. Now, taking a look at their balance sheet, we do find that the company has $12.9 billion in current assets, and then $2.4 billion of which is in cash and cash equivalents. And then if we compare this to the company's current liabilities, which is debt and other obligations that they do have to pay off and cover within the next year, it's sitting at $9.2 billion, so that well exceeds all of their current liabilities. So basically, if the company didn't produce any earnings over the next year, they'd have to start relying on their balance sheet, which would be able to completely cover all of their liabilities. but it's absolutely insane to think that 3M will not make any revenues or earnings over the next year because their products are required everywhere across the world. All right, guys, now the second recession-proof dividend stock on my list today is one that's actually in the consumer discretionary section, and it's probably a company that you've never heard of before. It's actually called McDonald's with ticker symbol McD. Now, because this is such a small company, I'm going to have to give you guys a really good introduction on this one. And as we all know, McDonald's is a worldwide company operating in basically every single country in the world, it seems, with prime real estate all over the place. Now, when many people think of McDonald's, they think of McDonald's being a burger company, and that's actually only part of the story. I personally believe that McDonald's is more so a real estate company than a burger flipping company. The burgers simply just bring in the cash flow, whereas the real estate is where the assets and the equity lies. Because McDonald's owns so much prime real estate across all of these major cities across the world, these asset values have increased substantially over time, and that is building into the value of the company. Now, even before the current issues in the market that we're seeing, McDonald's was criticized for a lot of the debt that they have on their balance sheet, being about $34 billion in long-term debt. And even though interest rates have dropped to zero over the past month, the majority of McDonald's debt is in fixed-term loans, so this really won't help them that much on the long-term debt side. And so what we saw in their stock price performance is that the stock actually did drop quite substantially before the current issues in the market, and then the current issues just brought it down even further. But right now it's sitting about 20% off its all-time highs. Now, I myself actually own a position in McDonald's. I bought when the CEO got fired in late 2019, and I thought that was a really good buying opportunity because I got in at about $189 per share. The company is posting a dividend yield of 3% right now with a payout ratio of only 60%, meeting my personal criteria. And ever since the company started paying their dividends in 1976, 44 years ago, they have not stopped paying and increasing their dividends every single year, which makes them a dividend aristocrat. But if that isn't enough for you and you're worried about McDonald's debt and everything on their balance sheet, let's take a look at their current assets versus their current liabilities. So right now we can find that McDonald's has current assets of $3.6 billion in total, and then a total cash amount of $900 million on their balance sheet, while the company has the same amount of current liabilities as their current assets, being $3.6 billion. So if they really wanted to, and if they were in dire need to pay off those liabilities, they could immediately. So giving you guys my personal thoughts on the company, I do think that McDonald's will be impacted by the current issues in the market because a lot of people aren't going outside and they're not eating at restaurant chains, and that's a big part of McDonald's business. But I also think that McDonald's will be able to survive this storm, and when things get better, many people are going to flock to their restaurants, and if they haven't already been ordering takeout, then that's an option too. But it is important to note that since this is a consumer discretionary sector stock, it will be hit a little bit harder than some other companies like 3M, which really isn't consumer discretionary. It's a lot of products that are necessary for day-to-day life and business operation. So make sure to keep that in mind if you are looking at McDonald's as a potential buy right now, and of course, make sure to do your own research. All right, guys, getting into stock number 3 here, and this is one of the most well-diversified companies in the world right alongside 3M, and that is Johnson & Johnson with ticker symbol JNJ. Johnson & Johnson specializes in 3 main industries where they produce pharmaceutical products, medical devices, and consumer products. And they own some of the top brands that you'll recognize across the world like Tylenol, Band-Aid, Neutrogena, Aveeno, Johnson's Baby Products, and so many more. Now, because a company like this has such a well-diversified and strong business model, they really haven't dropped a whole lot off their all-time highs, being about 20% off those highs. But I do have a position in this company at an average cost of about $129 per share, so I think that right now it's presenting a great buying opportunity if you're looking at the long term of things. Their current dividend yield is sitting right at about 3%, with their dividend payout ratio just at 67%, which really isn't that bad in my opinion at all. Companies like 3M and Johnson & Johnson can afford to have these higher payout ratios because they have so many different products that people are always going to need to buy, and that means that their earnings won't drop as much and their payout ratios can be higher to sustain that dividend over the long term. On the other hand, if you find a company that sells consumer discretionary products or a lot of amusement products that really aren't necessary for life, their payout ratio should generally be lower because they won't be able to support those earnings during a recession or a bad period in the economy. So on top of Johnson & Johnson's sustainable dividend, they have been paying and increasing this dividend for the past 57 years. And then taking a look at this company's balance sheet, it is pretty stellar with $45.2 billion in current assets and then over $19 billion in cash on their balance sheet. Then with their current liabilities of only $35.9 billion, we can see that their current assets would easily cover these current liabilities in a scenario where they didn't make any earnings. So overall, guys, I think Johnson & Johnson is one of those companies that I'll be holding forever because their dividend will continue rising, their stock price will continue rising. It's overall an amazing business. All right, now the fourth stock on the list is one company that you've probably heard of quite a lot recently, and that is Clorox with ticker symbol CLX. Now, Clorox is a leading multinational manufacturer of consumer and professional products with over 8,700 employees worldwide, so they are a lot smaller than some of the other companies that I've talked about, but nevertheless a recession-proof stock. The company produces many well-known brand-named products like Pine Sol Cleaner, Brita, Burt's Bees, and many others across the globe. And right now, the company is very well known for their Clorox bleaching products and other sanitizing agents that you can't even find in the grocery stores right now. It's absolutely ridiculous, so I would assume that this company is going to do very well over the next few quarters. And furthermore, I believe this will position them for further growth well into the future because a lot more people are going to be conscious about these cleaning products and using them on a day-to-day basis now. So as we would expect, this company is not far off of its all-time high price right now, being only 10%. And really that isn't off of an all-time high before this whole issue in the market happened, because that new all-time high was created during this issue in the market. And since the stock price hasn't really dropped a whole lot, this company's dividend yield really isn't the highest. It's not as high as the other ones that I'm going to be talking about in this video or that I have talked about. And so it's sitting at about 2.5% for their forward yield. But they do check off the box for the payout ratio, which is 63% right now. And then they have been paying that dividend consistently and increasing it every single year for 43 years, ever since 1977, so that's pretty insane. Now, taking a look at this company's balance sheet, we find that they have current assets of $1.3 billion and then $111 million of cash and cash equivalents. And although their current liabilities are at $1.4 billion, which is slightly above their current assets, this does not worry me in the slightest because what they're seeing right now is actually increased revenue from normal and increased earnings, so they have nothing to worry about. And guys, even if we saw this company in a different type of recession scenario where they wouldn't benefit from what's going on in the market, I really can't see their earnings dropping a whole lot because a lot of their products that they produce are need-based. Everyone's always going to have to continue cleaning their homes with Clorox products and a lot of their other products that are necessary for day-to-day use. So even though this company really isn't that far off of its all-time high, I still think that it could be a good buy right now because when their next earnings reports come out, I feel that it's going to be very positive and that they will survive throughout the next few months at least and well into the next few years based on the current economic conditions. All right, guys, coming in with stock number 5 and probably the best of all of them that has survived through so many recessions already, and that has got to be Procter & Gamble with ticker symbol PG. Can we just admire the fact that this company has been around for 182 years now? That is absolutely ridiculous. I mean, come on, guys. This is a recession-proof stock. So getting into their background, Procter & Gamble manufactures a ton of products that a lot of people need around the world, such as personal hygiene products, laundry detergents, feminine care products, home care products, oral care products, and the list goes on. And some of the common brand names that you might know are Crest toothpaste, Gillette, Old Spice, Tampax, Bounty, Tide, and so many more. And even though we've seen their stock price grow so much over 2019 alone, they really aren't that far off of their all-time high, being about 15% off that all-time high. Now, do I think that this company is really cheap right now? Absolutely not. I don't think that they're cheap, especially based on the valuation metrics right now. But it is very hard to find this company on a good dip. So I think that if they manage to fall a little bit more, I would be a buyer of this company despite their current valuation metrics, because they are such a well-diversified and amazing company that really deserves this higher valuation. So what we find is that their forward dividend yield is sitting right below 3% right now, so definitely not the best dividend yield, but they do have a payout ratio of 66%, so we can rest assured that they will be able to pay that dividend in basically all economic conditions. And we also find that their dividend growth streak, meaning they grow their dividend every single year, that has been for 63 years already, and they actually haven't missed a dividend payment for 120 consecutive years. Now, taking a look at their balance sheet, we do find that at the end of 2019, they had current assets of just over 22 billion, which included their cash hoard of just over 10 billion. And oddly enough, we actually find their current liabilities to be quite a lot higher than their current assets at 30 billion, but I really don't see this as a concern, and let me explain why. Procter & Gamble can get away with something like this by us simply looking at the products that they sell, being personal hygiene, laundry detergent, feminine care products, etc., and the list goes on. It doesn't matter what economic conditions we are in, this company is always going to be producing and selling these products. And we really only care about the balance sheet and how much current assets they have versus their current liabilities if that company is not making earnings in the short term, which is never really a possibility for Procter & Gamble. But along with that, their diversification gives this company so much leverage, so even if they can't sell one product or people don't want to buy two products, they have hundreds, if not thousands, of more products that they can continue selling and that people will need on a daily basis. So anyways, thank you guys so much for watching the video. I really do appreciate you watching. If you did agree with these picks, let me know down below, or if you think that you have some better picks, also let me know. I'm open to suggestions. Also, if there is one company that many of you guys want me to analyze in great detail, going into all of the valuation metrics and the balance sheet and everything, comment down below and the top comment will be analyzed sometime in the near future. So anyways, if you did enjoy this video, make sure to smash that like button as usual. And then if you haven't already, definitely consider subscribing for more content on personal finance, business, and investing in the near future. And I will see you guys in the next one.